Hello traders, welcome back to the Forex Gig, and in today's video we're going to be talking about the ladder bottom candlestick pattern, a powerful reversal formation that signals potential market bottom. This 5 candle pattern helps traders identify exhaustion in a downtrend and presents high probability trading opportunities. Whether you are trading forex, stocks or the cryptocurrencies, mastering the ladder bottom pattern will enhance your ability to spot market reversals before they happen. So by the end of this video, you would know how to identify these patterns, understand its psychology and implement a practical trading strategy using this pattern. Alright, let's get straight into the pattern explanation and know what this pattern is all about, because this pattern forms only during a downtrend and consists of 5 distinct candlesticks that signals a potential reversal. So let's break down its structure and characteristics step by step. The pattern begins with 3 consecutive bearish candles, and as you can see, the 3 consecutive bearish candles, 1, 2, 3. These are the consecutive bearish candles, each with long bodies and minimum shadow wicks. And as we can see, the last 3 candles had minimum body and smaller shadow wicks, as we can see in this area. You can also see in this area. So the key is to notice how each candle closes near its low, and as we can see, each of the candle closes near the low of the next candle. The 4th candle marks the start of the change. It is still a bearish candle, but it is smaller in comparison to the previous candle, and as we can see, this candle is small in comparison to the previous candle. Now the final and most crucial element is the 5th candle, and the 5th candle is a strong bullish candle that gaps up. Remember, it has to gap up from the previous close, signifying buyers are taking control. And as you can see, this bullish candle gapped up in price, showing that buyers are in control of the market. The pattern reliability depends on several critical characteristics. First, we have to look for the pattern to form after a clear downtrend. As you can see, this pattern is in a downtrend and it is forming in a clear downtrend where the market is making series of lower lows and lower highs. As you can see, the market is in a downtrend. So after this downtrend is when we see the pattern. At the end of the downtrend is when we can spot our pattern. Remember that the pattern reliability depends on several critical characteristics, like looking for the pattern in a downtrend. Remember, the first 3 candles should show progressive lower lows. So these are the candles showing progressive bullish candles, bearish candles rather. Then we have to confirm the selling pressure. We can make use of our volume, because the volume plays a crucial role in this chart. The volume, you will see higher average volume followed by declining volume, and as you can see, we saw higher average volume followed by a decline in volume. This volume bar declined. The 5th candle should show a significant change in the volume bar, and as we can see, the 5th candle showed a change in the volume bar. It's no longer a red volume bar but a green volume bar. This confirms buying interest, and the size relationship between the candles matters too, and as you can see, there is a size difference followed by the gap in the price. Remember, this pattern works best when all these characteristics align. The more confirmation factors present, the higher the probability of a successful reversal. Now let's see how we can implement the ladder bottom pattern to a trading strategy. The entry point comes after the completion of the 5th candle. After the 5th candle, this candle over here that gaps, this is when you would want to enter you have to wait for the next candle to open and break above the bullish fifth candle, and as you can see, the next candle broke above the fifth candle. This confirmation reduces fake signals and provides a more reliable entry point. So we would enter the moment price breaks above the fifth candle to confirm the direction that the market is intended to go to. We will enter the trade and we would put our stop loss. Let's not forget, place our stop loss just below the low of the fifth candle low, just below the low of the fourth candle, rather fourth candle low. That's the lowest point in the market, because if price gets to this level, it invalidates the setup. And the next thing you need to know is where you should exit your trade. We have to set our profit target to a minimum of 1:2 risk to reward. 1:2 risk to reward, so that for every dollar you risk, you get $2 in return. If your stop loss is 20 pips away, your profit target should be 40 pips to your entry. The second target can be set at a significant resistance area. You can target a previous resistance area in market, because this is a previous resistance area. These are places that we expect price to hold before any reversal would occur. These are the areas we can set our profit target to. Now let's not forget, position size matters in any trade. Here are some examples of position sizing that you need to know. When risking 1% of your account, you should at least confirm your position size. You make sure your stop loss is accumulated in such a way, is calculated in such a way that 1% of your account would be what you are willing to risk on a trade. If you are using a 20 pip stop loss, you have to calculate from your entry to your stop loss that whatever you lose, if it was a losing trade, you would only lose 1% of your account. This is what is allowed for you to risk per trade on this trading strategy, because no trading strategy is 100%. We can consider scaling out of position by taking partial profits at the first target, and we can also let the remainder run to the second target. That means we can use multiple targets, like first target and second target. Our first target can be 1:2, and our second target can be maybe previous resistance area, or we can let it run, and once we see a sign of bearish momentum, or we see a sign of reduced volume, we can leave the trade. We have to always confirm this pattern on a higher time frame. We confirm on a higher time frame, a ladder bottom on the higher time frame, to consider if it aligns with our entry time frame. A ladder bottom on the 1 hour chart becomes more reliable on the 4 hour to show its oversold condition. And when you see a ladder bottom on a 4 hour, you can further confirm this on the daily time frame. When you confirm this on the daily time frame, it makes it easier for us to further confirm our entry. So let's go to the higher time frame to see what the higher time frame was telling us about this setup. And as we can see from the higher time frame, we can see market is in a bullish phase, where price has already showed us a shift in structure. In this area. This was merely just a continuation using the ladder bottom candlestick pattern to continue or to ride the trade to the upside. So the higher time frame is crucial when taking this trade. We have to always confirm that we are trading in line with the higher time frame objective. The ladder bottom pattern serves as a reliable tool for identifying market reversal. When properly traded, you will now understand the 5 candle formation. It is a key characteristics, and how to implement a practical trading strategy using this pattern. Remember to confirm with your volume, maintain a strict risk management, and always wait for the 5th candle confirmation. Success with this pattern requires patience, because you have to wait for all your elements to align before taking a trade. Alright traders, we have come to the end of this video. Hit the like button and subscribe to the channel. Turn on notification bell by clicking the bell icon for more forex trading strategies. I wish you happy trading and thank you for tuning in, and until next time, trade safely.